Welcome back. Now in the previous video we looked at the primary market. In this video we are going to look at the secondary market. Now we said that the primary market is where the various securities are issued for the first time. After the process for issuing securities is complete, these securities are available for regular trading in the secondary market. So essentially the universe of stocks you can trade on the exchanges actually constitutes the secondary market. Now you should understand that the transactions in secondary market do not result in additional capital to the issuer. This is so because only existing shares are traded between different investors and the issuing company doesn't receive any funds because of the trades in the secondary market. The capital raising function for which the stock markets are used, now this function is only performed by the primary market, while the secondary market supports the capital raising function of the primary market by providing liquidity, price identification, and information signaling. Secondary markets also act as the barometer of economic activity. Actually, secondary markets serve a range of important functions. We'll look at each of these one by one. The first important function of the secondary market is that secondary market provides liquidity and thus improves marketability of existing securities. This is so because secondary markets provide investors the option to sell their equity shares. This implies that the investors can stay invested without the fear of their funds being blocked, as they can now sell their shares whenever they want to. This also means that new investors get the opportunity to buy these shares if they want to. Also, secondary markets enable price discovery of traded securities. Now, the price at which an investor buys or sells a security depends on his assessment of future prospects of the company. The logic is that when a company performs well, it is likely to attract buyers. Similarly, when the business suffers, there is a lack of buyers as many of the existing investors would like to sell their holdings. Hence, there is a continuous market evaluation of the company and its future prospects. This continuous process also benefits issuers when they have to raise further capital from markets because their existing security is trading at a fair indicator of the price at which fresh capital can be issued by them. Secondary markets also serve as an indicator of economic activity. Secondary market trading data is used to generate various benchmark indices. Every country has some leading stock indices which are continuously tracked and are viewed as the barometer of economic performance. For example, there is S&P 500 and the Nasdaq in US. There is the DAX in Germany. There is the Sensex and Nifty in India. A sustained rise in these indices indicates healthy revenue, profitability, flow of capital investment, and expansion in large companies. This also indicates a strong growth in the economy, as many times the company in these indices are the source of a chunk of GDP output for the country. Similarly, a decline in indices may indicate a weakening economy. Hence, secondary markets serve as a quick indicator of economic activity. Also, secondary markets are many times referred to as the market for corporate control. Essentially, markets promote efficient governance by facilitating changes in corporate control. For example, if a management is inefficient, the company will likely perform below potential, which would probably lead to a fall in their share prices and consequently undervaluation. This would lead it to become an acquisition target, and acquirers would likely replace inefficient management with efficient management. Hence, there can be a change in corporate control facilitated by the secondary market. Now that we have covered the basics of the primary and secondary market, now what we are going to do in the next lecture is look at how the prices for various securities are set in both primary and secondary markets.